Hi there, this is Jean Falb, enrolled agent, certified tax coach. And today I wanted to talk to you about a situation that's close to home for me. My husband and I sold a piece of investment property in 2018, and I wanted to show you the three different perspectives of how that shakes out for taxation, for your actual loss, whether or not you get a check from the title company, and they're all very different. And so I'm going to just start with the first one here. This is from the tax return perspective. So we sold the house for 190, we paid 250, and we spent 14,000 on commissions, etc. And over the course of the ownership of this property, we depreciated $57,751, and we received a tax benefit for that. So like many depreciable assets, at the time of sale, you have to recapture that. Sometimes it's just easier to think of it as you're having to repay it. So you can see that on our tax return, our net loss was $16,000. Now, in reality, we spent $250, we sold it for $190, we had those closing costs. So actually, we lost $74,000. That's kind of painful looking at that right now. Okay. And then yet again, from the title company, they had the 190 of proceeds. We know that we had to spend $14,000 in costs. And they had to pay off the mortgage. And so that resulted in a check of $35,000 for us. So if you compare them, you can see that the net gain or loss is different in every single scenario. And so I want to really just emphasize that in the first scenario, you're going to have to pay back your capital gain. In our case, your depreciation. In our case, we still ended up with a loss because it was such a big loss to begin with. And so hopefully this won't be your scenario, but just keep in mind that if it's not simple math, oh, I sold it for 300 and I bought it for 250, oh, I'm going to have a gain of 50,000. It's just not that simple. So I want you to be thinking about that. And a mortgage is not a factor in calculating the gain for tax purposes. The IRS doesn't really care if you had to borrow to buy the property, because all they're really interested in is the acquisition cost, not whether or not you financed it. So in our case, we did get a little check back, which is really represented the equity because we had paid down the mortgage. But this came as a surprise to a client I used to have who left me over this, which is fine. I want them to be comfortable. And they had, after their mortgage and the title company scenario here, they actually owed a little money. I think it was about $5,000, which to them was a lot. And so they couldn't understand how they could owe money on the transaction but have a gain for tax purposes. And I try to explain the depreciation recapture. It's kind of a strange concept, but they weren't prepared for that. And so they ended up having a gain. And it was really a sting because not only did they have this issue with having to pay at time of closing, but now they had a capital gain and owed money. So it was not pleasant for them. They went somewhere else, and I hope they got a better answer, but I don't think they did. So real estate investing can be an effective component to an advanced tax strategy. Depreciation recapture shouldn't stop you from that, because the idea, of course, is you're trying to build wealth. If you want to explore an advanced tax strategy, you can utilize a 30-minute free tax discovery. You can do this at the website listed here. If you just rather set an appointment, we can have a conversation before you move into going directly to the website. We can do that too. So I have lots of other tools in my toolkit to set you up with an advanced tax strategy if that's something of interest. So with that, I am going to go ahead and stop recording, and cheers. Have a great day. Bye-bye.